Hey, how are ya? My name is Tadashi, mortgage agent in Toronto, and we're talking about buying your first home from a mortgage perspective. In this video, we're looking at a short comparison between committing a down payment of less than 20% and 20% or more. The goal here is to give you a visual breakdown of how your down payment choice may affect your mortgage experience. In this scenario, we're looking at a purchase price of $1 million. On the left side, we have the less than 20% option, also known as a high ratio mortgage, and on the right, we have the 20% or more option, also known as a conventional mortgage. What we're going to do is start at the top, work our way down, and I'm going to explain each point as we go. Let's get into it. First is the down payment. This is your stake in the purchase, and the amount you commit will affect everything else we see here today. For the high ratio option, the minimum amount that you can commit on this purchase price is $75,000. For the conventional side, you will need to commit at least 20%, and in this case, it'll be $200,000. That's an initial cost of $125,000 in terms of difference. Next, we have the mortgage insurance premium. So, what is this premium? Well, one of the requirements to get a high ratio mortgage is that the lender must purchase mortgage loan insurance. Before they can get it, you need to meet additional criteria outlined by the insurer. Now, while the lender buys the insurance, they will pass the cost of it onto you. Also, the cost of the insurance will vary depending on the size of the down payment. The lower your down payment is and the closer it is to the minimum amount required, the higher your premium will be. In this scenario, because we're committing the minimum down payment of $75,000, you'll have the highest premium cost of $38,850. For the conventional side, there is no requirement for the insurance, so there is no additional cost of the premium. And that leads us to the total loan. To get it, we have the purchase price minus the down payment plus the premium, giving us $963,850. This is because of the repayment of the premium cost. There are two ways you can pay it off. Option 1, it gets paid off before the closing date, separate from the closing costs. And option 2, the premium is added to your loan, increasing the total mortgage. In most cases, the premium is added to the mortgage, so that's what we're going to do here. For the conventional side, it's simply purchase price minus the down payment, giving us a simple $800,000 as the loan. Moving on, we have the interest rates. For the high ratio, we have a low rate of 4%, and for the conventional, we have a higher rate of 4.5%. This is because conventional mortgages come with higher interest rates, especially when they're compared to high ratio ones. Next, we have the amortization. This is the total amount of time you have to repay the loan. The longer amortization, the lower your individual payments will be, which can help to improve your qualification. Now, while you have 30 years in this case to repay the loan, you don't have to wait the total amount of time to pay it off. Most mortgages come with options that let you pay off the mortgage faster, like increasing your payments or increasing the frequency of how often you pay your mortgage. Finishing off, we have the monthly mortgage payment. In this scenario, if you choose the high ratio option, you'll have a monthly payment of $45.83. And for the conventional side, you'll have a monthly payment of $40.33. That's a difference of about $550 in terms of cash flow. Now that we have all the information in front of us, I'm going to quickly point out the benefits and drawbacks for both options. For the high ratio side, you'll be able to commit a much lower down payment and help you save a significant amount on your initial costs, which can help you get into the market sooner. Not only that, but your interest rates will be lower as well. However, because you're borrowing more money and the potential cost of the premium, your loan and mortgage payments may be higher. On the other hand, on the conventional side, your initial costs will be much higher and it may take longer to gather the funds, especially if you're looking to buy in a higher priced market. Not only that, but your interest rates will be higher as well. However, your loan and mortgage payments may be lower. Alright, so that's a quick overview of this down payment comparison. Keep in mind, your situation may vary, and it's important to understand your options and what your potential costs may be with either choice. Thanks for watching. If you have any questions, leave them in the comments, or if you'd like to have a deeper discussion regarding your situation, feel free to reach out using the contact info in the description. Take care.